Hey traders, Gavin McMaster here from Options Trading IQ, and today I'm going to show you a Tesla Iron Condor adjustment that I'm looking at for today. Just a reminder that everything discussed is for educational purposes only, is general in nature and does not take into account your personal circumstances. So this is the original trade. This was from the 13th of November, so just under 2 weeks ago. And you can see we started with a slight positive delta. It's actually a really interesting example because of the positive momentum in Tesla. We've actually got higher volatility in the calls than we had in the puts, which is quite rare. Usually you only see that on a stock that's very, very bullish. So you can see there's a lot of demand for calls in Tesla since the election. The stock's been rallying. And for that reason, the implied volatility is higher on the calls than the puts. So not something you'd see very often. We see it a little bit with Nvidia, not so much now, but a year or two ago when it was having its big bull run, and Tesla back in, I think it was 2020 or 2021 when that was having its huge run as well. So not something we see all the time. And you can actually see the short call delta is 18.6, and the short put delta is 13.5. But even though the 18 delta is higher than the 13, it's actually further away. And again, that's because of the volatility and all the demand for the calls at the moment. So I felt like this was a pretty well-structured trade at the time. We had a huge margin on the upside up to 410 and all the way down to 275 on the downside. So slight positive delta to start with, delta 1, basically neutral. There's our T+0 line. So let's go and check in on how the trade is looking now. Okay, so here we are now. We're up about $50 for this sample of 2 contracts. We've moved to slightly negative delta. The stock has rallied up. We've now moved to about a 22.5 delta on those calls, but the short put delta has dropped all the way down to 6. So that's been a big drop. We can also see that that's only worth about 30 cents, that spread. So it's not doing a whole lot for us in terms of helping the position. Now, we don't really need to adjust, but I would look at something in this scenario where I kind of classify adjustments as either defensive or attacking adjustments. I don't feel like we need to play any defense here on the calls at 410. I think they're pretty safe for now. I will be keeping an eye on them. If we get up above sort of 370, 375, I might look to play some defense and roll those out a little bit. Maybe see if I can roll them out to 420 as the short strike. But on the put side, what we can do is do what I call an attacking adjustment, which is rolling the untested side in. We can generate some more premium by doing that, and we'll also get ourselves back more towards that neutral delta and back towards the top of the T+0 line. So this is a really great adjustment, particularly if you think Tesla's going to remain steady or fairly strong and not drop too much. You can sometimes get into trouble doing an attacking adjustment where you roll these puts in and then all of a sudden the stock reverses and moves back down again, and then you're getting under pressure on those puts that you've just rolled in. So it is a little bit riskier than a defensive adjustment, but we generate more premium, so there's a bit of compensation for that risk. And as you'll see, once we look at rolling these puts in, I think the new position is looking pretty good. So you can see at the moment there's about $200 in premium remaining in the trade. So what we would do is we would buy to close these ones. That closes out them. And then we'll look to roll those up. And I'd go back to that sort of original starting delta that we had of about a delta 13, which is right there, perfectly around that 300 strike. A lot of liquidity there. You can see a really tight bid-ask spread, over 4,500 contracts traded on Friday. So yeah, I think 5 points wide for that. So we buy to close that one. Those are done. And then we roll up to here. Sell 2 of those, buy 2 of those. And you can see now we've got nearly $300 in premium now. So we've generated about $90 to $95 from buying back the old spread and selling the new spread at the higher strikes. And you can see that's perfectly neutralized our delta as well, delta 0. If we wanted to be a little bit more aggressive, we could roll this in a little bit more, depending on how strong you think Tesla's going to be over the next few weeks. If you think it's going to be a really continuous upward momentum, you might be a little bit more aggressive with the puts and roll them into, say, 310 or 315. So the other advantage of what we're doing here with this attacking adjustment is generating that extra $90 in premium. It increases the profit potential in the trade. It increases the amount of premium we've received overall. And that will help us if we then need to make any sort of defensive adjustment. If Tesla continues rallying, we can buy back this spread, roll it out, that's what I would call a defensive adjustment. That's going to be a debit trade that's going to cost us a little bit of money to make that move. But because we've just generated that extra $90 in premium, we've got plenty of capacity for that defensive adjustment. So that'll be my next step. Like I said, if Tesla gets up to that 370, 375 level, I'll buy these back, roll them out, and play a little bit of defense. So I hope you enjoyed that little tutorial there on making adjustments on Iron Condors. If you've got any questions, feel free to sing out. Otherwise, have a great day.